6 weeks ago, in Phoenix, Arizona, a 44-year-old project manager named Renee got a push notification from her Chase banking app on a Wednesday afternoon at 3:14 p.m. The notification said, "Update your income to potentially qualify for a higher credit limit." Renee had just been promoted 3 weeks earlier. Her salary went from $134,000 to $156,000. She thought, why not? She tapped the notification, updated her income to $156,000. Took 11 seconds. 6 weeks later, Renee's life had quietly changed in 5 specific ways she didn't realize were connected to that 11-second tap. Her mailbox contained 4 new pre-approved credit card offers, 3 of them from banks she had no relationship with. Her email inbox was getting an average of 7 new financial marketing messages per week, up from about 1 per week before the update. The personalized offers inside her existing Chase app had shifted dramatically. The credit card she'd had for 5 years was now showing her installment loan offers, balance transfer promotions, and a $40,000 personal loan recommendation she had never asked about. The pre-qualified mortgage refinance estimates she was getting through her bank's portal were 0.4 percentage points higher than what comparable rates were showing on independent rate comparison sites. And, this one she only learned about at a backyard barbecue 2 weeks later, the credit limit increase she'd hoped for never actually came. Her limit stayed at $14,000. The income update had been used for almost everything except the thing she clicked the notification for. By the end of it, Renee understood something almost no consumer banking customer is ever told. I'm Trish, and I sit across from the people who built and ran these systems for a living. So the 4 specific things your bank does with the income figure you give them, and the specific times when you should answer the question versus quietly decline, you're going to know by the end of this video, from a former bank executive who actually knows. Here's what makes this trap so quiet. When you applied for your first credit card, your bank asked for your annual income. You told them. That was correct. Federal law actually requires banks to ask for your income at the time of application, under the Credit Card Act of 2009 and Regulation Z. They cannot extend credit without considering your ability to repay. What almost nobody knows, once you've been approved, the bank has no further legal right to require updates to your income. The periodic pop-ups, push notifications, and emails asking you to update your income for better offers are voluntary. You are not obligated to respond to any of them, ever. But people do respond, because the prompts are designed to feel routine, to feel like a software update, to feel like helping the bank help you. The reality, every time you update your income upward, you are voluntarily handing your bank a more accurate marketing profile, a more aggressive risk model that wants to extend you more debt, a list of cross-sell products targeted at your new spending capacity, and a piece of data that gets shared with affiliated entities and marketing partners across the entire financial services ecosystem. The bank does not primarily use your updated income to give you better service. The bank uses your updated income to extract more revenue from you, through credit limit increases that encourage spending, new product offers that fit your new income bracket, and risk model adjustments that subtly change how you're treated across every product they offer. Renee's story is not unusual. It's the standard outcome for anyone who responds to those income update prompts. The bigger your income jump, the more aggressive the post-update marketing becomes. Today, I'm walking you through Theo's exact 35-minute breakdown. The 4 specific things the bank does with your stated income, why each one quietly works against you, and the framework Theo gave Renee for when to answer the income question and when to quietly leave it alone. One thing before Theo's breakdown. I am not telling you to lie about your income. Lying on a credit card application is fraud, with real legal consequences. The bank can verify your income through the work number, IRS transcripts, or pay stub requests at any time, even years after approval. What I am telling you, there is a meaningful difference between when you are required to provide income, initial application, formal credit limit increase requests, mortgage applications, refinances, and when you are not required to provide income, random push notifications, marketing prompts, update your information for better offers. For the required interactions, always provide accurate information, including all eligible income sources: gross salary, bonuses, investment income, spousal income, retirement income, public assistance. The fuller your income picture in the required interaction, the better your terms. For the optional interactions, which are most of them, there's almost always a strategic case for declining the prompt and keeping your existing profile. Here's why, in Theo's actual words. Theo set down his beer, took a paper napkin from the picnic table, wrote down 4 specific things the bank does with updated income data. Item 1. Risk model recalibration that increases your debt exposure. Banks run sophisticated risk models that determine how much credit they're willing to extend to each customer. The model has thousands of variables. Income is one of the biggest. When you update your income upward, say from $134,000 to $156,000, the model recalculates your ability to absorb debt. The model concludes you can now safely service approximately $22,000 more in additional debt across all your accounts. The bank's response is automatic. New product offers calibrated to that additional debt capacity. Higher pre-approved credit lines on cards you don't have yet. Personal loan offers in the $20,000 to $40,000 range that didn't exist in your offer queue last month. Auto loan pre-qualifications that target the kind of vehicle someone earning $156,000 should be driving. None of these offers are evil. They are the bank doing exactly what banks do, earning revenue by lending money. The point is, by updating your income voluntarily, you ask them to recalibrate. They did. Now you face a flood of offers designed to capture the additional debt capacity you signaled you could handle. The actually wealthy don't update their income upward voluntarily. They keep the bank's model calibrated to a lower number. The flood of offers stays small. Their lifestyle inflation pressure stays low. Item 2. The marketing data sale and sharing. This is the part that surprises most consumers. Your stated income is shared, directly or through affiliated entities, with marketing partners across the financial services industry, sometimes through formal data sharing agreements, sometimes through affiliate marketing networks, sometimes through the bank's own affiliated subsidiaries that handle insurance, investments, mortgages, and lending products. This is largely legal under most consumer banking privacy disclosures you signed when you opened the account, in 47 pages of terms and conditions you didn't read. The 7 times per week marketing email volume is the same mechanism. Once your updated profile hits the partner network, you become a higher value target for solicitation. Until your income drops, the volume stays elevated. The wealthy minimize their footprint in these networks. They don't volunteer income data. They don't update profiles. They don't fill out optional surveys for better offers. Their marketing exposure stays low because their data signature stays small. Item 3. The cross-sell algorithm activation. This is the one Renee saw inside her own Chase app. When your income data updates, internal cross-sell algorithms activate. The algorithm identifies products you don't currently have, but that match the profile of someone with your new income level. Then it surfaces those products in your in-app recommendations. None of these offers are mandatory. Renee can ignore them all. But the visual presence of them, every time she opens the app to check her balance, creates ambient lifestyle inflation pressure. The bank is suggesting, hundreds of times a year, that someone with her income should be doing more borrowing, more spending, more lifestyle expansion. Most people respond to this pressure eventually. Even disciplined savers find themselves clicking through to see what the offer is. Some take the balance transfer. Some take the personal loan. Some pre-qualify for the mortgage they weren't planning to refinance. Each one extracts revenue. Each one expands the bank's relationship with the customer in ways that benefit the bank more than the customer. Item 4. The rate and term differential nobody talks about. This is the most damaging one. Theo paused before explaining it. Banks have multiple channels through which they offer products. The internal channel, the offers you see when you log into your existing bank's portal. The pre-approved external channel, the offers you receive in mail and email. The independent rate comparison channel, the rates available when you shop the market openly through aggregator sites. The rates and terms a bank offers through the internal channel are routinely worse than what the same bank would offer the same customer through the open market comparison channel. Theo gave Renee a specific example. Her Chase pre-qualified mortgage refinance estimate after the income update came in at 6.85%. The same Chase product, when Renee shopped through Bankrate's aggregator site as an anonymous comparison, came in at 6.45%. Same bank, same customer, different channel, different rate, 0.40 percentage points difference. On a $400,000 mortgage refinance, about $33,000 in additional lifetime interest. Why? Because the internal channel customer is a captive audience. They trust their existing bank. They are less likely to comparison shop. The bank can extract higher margins from them precisely because they don't realize the same bank offers the product at lower rates through open market channels. This is why the financial advisors I respect, and Theo, when he was working, always told their clients to never take the rate offered by their existing bank without comparing it to the open market first. The captive customer rate is almost always worse. The framework: when to answer, when to decline. Answer accurately. When applying for a new credit card, formally requesting a credit limit increase, applying for a mortgage or auto loan, refinancing an existing loan, opening any new account that requires income disclosure, or being asked by a regulatory or legal entity. These are the interactions where federal law actually requires income disclosure, or where your strategic interest is genuinely served by a complete, accurate income picture. Decline or leave blank. When the bank's app or website prompts you to update your income for better offers, an unsolicited email asks you to verify or update your income, you receive a paper statement insert asking you to confirm income. You're calling about an unrelated issue, and the rep tries to update your file or any other voluntary optional interaction where you are not actively seeking new credit or services. These are the interactions where you have nothing to gain by responding and several specific things to lose. Just don't respond. Or if a rep asks, say, "I'm not interested in updating my income at this time." There is no obligation. There is no penalty. There is no consequence for declining. The only real consequence of declining is that your existing risk model stays calibrated to your prior income, which means smaller offer volume, less ambient lifestyle inflation pressure, and a quieter banking relationship. The right move 6 weeks earlier would have been to ignore the push notification entirely. If she wanted a higher credit limit, the right move would have been to formally request a credit limit increase through the bank's increase request channel, which does require updated income, but which produces the actual outcome she wanted, higher limit, rather than the actual outcome she got, marketing flood plus higher rates. 3 objections come up here. Let me handle them. Objection 1. Won't a higher credit limit help my credit score by lowering my utilization? Yes, if you actually want a higher credit limit and you have a strategic reason to optimize your utilization right now, mortgage application coming up, major loan application, refinance, etc. In those cases, formally request the credit limit increase through the proper channel. Provide the updated income as part of the formal request. That's the right path. The trap is the other scenario, where you have no specific need for a higher limit. You respond to a marketing prompt anyway, and the income update produces all the downstream effects: marketing flood, cross-sell pressure, channel-specific worse rates, without actually delivering the credit limit increase you might have wanted. The distinction matters. Strategic, intentional credit limit increase request, fine. Reactive response to a notification prompt, usually a mistake. Objection 2. But I want my bank to know I'm doing well. Doesn't that help our relationship? This is the framing the bank's marketing department wants you to internalize. Your bank is not your friend. Your bank is a for-profit corporation whose primary obligation is to its shareholders, not to you. The relationship is transactional. The customers who get the best terms from their banks are not the customers who voluntarily share the most information. They are the customers who shop comparison sites aggressively, who threaten to leave when terms aren't competitive, and who maintain optionality in their relationships. After 32 years inside the industry, was clear about this. The customer the bank treats best is the customer the bank is afraid of losing, not the loyal one. The customer the bank trusts and assumes will stay no matter what gets the worst terms because no shopping pressure is applied. If you want to improve your terms with your bank, get competitive offers from other banks and bring them to your existing bank for matching. That signals leverage. Voluntarily updating your income signals exactly the opposite. It signals a captive customer who can be more aggressively monetized. Objection 3. If I don't respond, won't the bank get suspicious or lower my credit limit? No. Banks expect most customers to ignore most of their voluntary prompts. The prompts have low response rates by design. That's the marketing math. Your non-response is statistically normal. Banks do periodically run inactivity reviews, but those are based on transaction patterns. No use of the card for 12 plus months. Not on income update non-response. A card that you use regularly with on-time payments will not get reduced or closed because you didn't respond to a marketing prompt. The suspicious framing is itself a manufactured anxiety designed to push response rates up. There is no negative consequence to ignoring optional bank prompts. Period. Action steps. 3 steps. This week. None of them require any new spending or any difficult conversations. Step 1. Tonight. The notification audit. Open every banking app you have on your phone. Look for any pending prompts asking you to update your income, verify employment, or improve your offers with additional information. For each one, close it. Don't tap it, don't fill it out, just dismiss the notification. If the prompt reappears next time you log in, dismiss it again. The bank may keep prompting you forever. The non-response is the right response. 5 minutes tonight. Step 2. This week, the marketing settings review. Inside each of your bank's apps and online portals, find the marketing preferences or communication settings section. It's usually buried 3 to 4 menus deep. Opt out of every optional marketing communication you can. Promotional emails, pre-approved offer mailings, SMS marketing, app push notifications for personalized offers. You'll keep getting required notifications, security alerts, statement notifications, payment confirmations, because those are operational. You'll stop getting most of the marketing volume. Banks make this hard intentionally. The opt-out checkboxes are usually unchecked by default and require you to actively check them. Take 20 minutes per major banking relationship. The 60 to 90 minutes total investment dramatically reduces the marketing volume across your life. Step 3. This month, the Shop Then Ask framework. For any major financial product you're considering, mortgage, refinance, auto loan, personal loan, new credit card, establish a habit of shopping the open market before going to your existing bank. Use Bankrate, NerdWallet, Credible, or other independent rate comparison sites first. Get 3 to 5 quotes anonymously. Find your best market rate. Then go to your existing bank and ask them to match or beat the best market rate. If they can, great. Take the existing relationship convenience benefits. If they can't, you have direct evidence of the channel rate differential and you should take the better external offer. If this video helped you, Or if you've ever tapped one of those update your income prompts wondering what it actually did, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket, same way this one just did. 3 specific positions that capture the upside from the energy disruption while protecting the downside if the situation de-escalates. The kind of positioning that institutional money makes routinely and retail investors almost never see. Tomorrow, I walk you through the 3. Why each one? And the specific way working professionals can take similar exposure through low-cost ETFs without needing access to institutional research. If you have any meaningful money in retirement or brokerage accounts, tomorrow's video is genuinely worth your time. I'm Trish. Talk to you then.